In this video, we're going to cover creating a fund. And the main reason for creating a fund is simply because you want to raise capital, raise equity to buy more assets. Even if you're rich, you've got a few $1,000,000 in the bank and you invest that in real estate, once you put your capital to work, then you're going to have to wait a while before you get capital back. Real estate takes time. Let's say you deployed $3 million, you borrowed $7 million from the bank, you now have 10 million of assets. Great. It's going to be maybe several years before you get that 10 million, sold of assets, maybe for 15. Now you've got 8 million and you can reinvest. If you want to grow in the meantime, you need to use other people's capital, other people's money to help you grow your business. And it's not all for you. Of course, you're making great returns for investors, which is why they want to invest with you and grow with you too. It's just a way of scaling your business faster than simply using your own money and slowly growing over time. Or if you're saving money or doing another business and pumping money into real estate, it's the same thing. It helps you exponentially grow the amount of capital you have to invest, so that capital is no longer the limiting factor when you're trying to grow your business. Okay, so what are some of the benefits of creating a fund? One, raising capital, we just covered. Economies of scale. So if you buy one asset and you have one management team, including marketing, accountant, everything, it's kind of expensive. It's a big hit against the cash flow. But if you have 10 assets in a fund, the amount of work isn't multiplied by 10. The same team can basically do the work across multiple assets. So your costs go down, your profits go up, and you're managing more assets too. So lower operating costs overall. Especially if you then, for example, with storage, have a remote office for your marketing, your customer service, your call center, your operations, your repairs and maintenance team operating out of a single hub. It also lowers your costs and improves the profit per property too. You're also diversifying your income and your investments. Instead of now having all your eggs in one basket, which is one property, you now own 10 properties. You've got, from before you might have 500 units, you've now got 5,000 units paying you income every single month. Your cash flow is a lot more stable. One deal might do much better than you expected. One might do a little worse than expected. The fund smooths that out. Imagine you go in to buy a property with some investors and for some reason it doesn't quite perform as you expected. They're going to be disappointed and you could potentially, lose them as partners for the rest of your investing career. Now imagine you creating a fund. You raise money from investors. You buy 10 assets. One doesn't perform as expected, but 8 do great and another one does much better than expected. The overall performance is on target, right? Your average is much better, and so you don't have these lumps and bumps that you might do if you just had all your focus on one particular asset, and so you're much more likely to deliver solid returns for investors. Yes, you may hit it out the park with one deal and maybe not do so well with another. The fund smooths all of that out. Also, it gives you the capital to do deals that you might not be able to do otherwise, right? If you've got $1 million in the bank, you can maybe take down an asset between $3 to $4 million by yourself. But with a fund of 10 million, you can take down bigger, more stable assets that maybe you can buy yourself, because now you have financial partners on the sidelines with you and you're buying it together. You're able to take down a much bigger, more stable, better asset that you couldn't potentially do by yourself. Another reason for raising a fund is you've got quick capital. You're not waiting each time you do a deal to raise the equity. You're raising enough for the next 12 months of deal flow, basically. And so instead of every time you find a deal, having to pause, raise the capital, put the deal together, close, done, ready, you now got funds available to close on deals as they come up. So you're not having to go back to the market every time to get the capital. It also lets you hire better team members. Because you have these economies of scale, you've got 10 properties, 5,000 units paying you cash flow, you have more cash flow to allocate to hire better A-team players. If you've got one property, you can maybe support a part-time accountant. If you've got 10 assets, you can now support a full-time CFO that's experienced on your team. So raising a fund has many, many, many benefits on top of just simply buying more assets for yourself. it actually produces better returns, more stable cash flow, better team. It helps you to grow faster, scale faster. It gives you more credibility with investors. It gives you more credibility with sellers, and it puts you on the path to growing your real estate business, to tycoon level. What are some of the key considerations? Okay, so whenever you're creating a fund, of course, you have the general partner or the sponsor, and then you have the limited partners. And so basically the way it usually works is the limited partners provide the capital. The general partner will put some capital into the deal, but they manage the day-to-day amount. The first thing you want to consider is how much do you want to raise? Fund costs can be up to like $100,000 for the PPM, all the documentation, the legal fees, the setup, the structure, the marketing. So you don't really want to raise $300,000 and then spend $100,000 on admin fees to get that $300,000. It needs to be of a significant amount of 5 or 10 million or more for it to make sense to start with. The other thing you need to consider is realistically, what can you operationally handle over the next 12 months? What's your deal flow going to look like? How much assets can your team manage? And you want to aim somewhere which is pushing you, stretching you a bit, but you don't want to try to go too fast. There's no point trying to raise 100 million, then not having the deal flow or the team to actually be able to execute upon that, even if you're a great capital raiser. So you want to raise somewhere in your sweet spot that allows you to then basically raise the right amounts to cover your kind of estimated deal flow over 12 to 18 months. You deploy that capital, you build up your team operationally, you keep improving, and then you can go back and raise more for the next fund as well. Another key consideration is the preferred return. So what this is basically, let's say an investor puts in $1 million and they're expecting a return back on their investment. Some funds don't pay any preferred return. And what a preferred return is a percentage of the cash flow that goes to investors first before there's any profit splits or other payouts that are calculated. For example, investor puts in $1 million, they get an 8% back first, and then there's hurdles or there's different amounts of return before the profit is split between the investor and you for putting the deal together. And another thing you can look at it is basically you're paying for the use of their capital. It's like interest. So if you use like an 8% preferred return, investors get the 8% preferred return first, and then after that, how the money is split is called basically the waterfall. It's the payout structure. And the reason it's like a waterfall is, the different levels of water falling down, or the cash flow, how does that get distributed? And usually, very first thing that gets paid, of course, is all the operational expenses for the property, the debt for the property, anything to do with the expenses of running the property business itself, that gets paid first. But that doesn't include necessarily the sponsor, or the general partner, or you putting the deal together, your expenses. It considers the asset and the LLC and the fund expenses itself exclusively first. Then, if you have surplus cash flow, you go to pay back the investors their preferred return, their kind of interest on their money, and then you may have different splits. For example, anything over 10% return, you split 50-50 between investors and you. Or you may have a higher hurdle rate. Once you get over 20% annual return, or it's called IRR, then maybe you do a 50-50 split. Some investors will expect you to only take 30% and they get 70% of the profits over a certain amount. The waterfalls are very, very important, and the way you structure it is important because it helps you to attract people. If you're too greedy, if you say, okay, I'll give you the first 5%, and then after 90% goes to me and 10% goes to you, the investors, no one's going to do that deal. Right? They're going to walk away. But at the same time, if you give away too much, you're doing all the work for not as much return as you could have got. If you do, 10% preferred return for investors, then they get 90% of the profits, and you own 10% of the asset after that. You're being fair to them, but maybe too fair, right? You're being too generous on their side. The balance lies somewhere in the middle, and it really depends on what kind of returns you think you can get, what type of how much money back the investors are going to get. The more you can make the investors, the more you can take too, because that's fair. If you're only going to make 8% overall on the money, then there's very slim margins and there's no point almost doing the deal. If you're going to make high 20s returns, high 20% returns year on year, then investors are going to be happy to split the profit over a certain amount, over what's called a hurdle rate. So the next main point is the hurdle rate, right? So it's over which percentage do you start to get a split, and the split may increase as you go up the hurdle. So let's say up to 10%, all of it goes to investors first, right? Then over 10%, it might be split 70% to investors, 30% to the general partner, you for putting the deal together. But then over 20% return, you might do the 50-50 split. And so you have this waterfall structure with different hurdles along the way, and you get more of the share as you make more money for investors. And there's other things to consider too. For example, let's say you have 10 assets in the fund and you sell one. What happens with the money? Is it split at the end, which is a European style waterfall? Once investors have all of their cash back, then you're splitting the profits from selling assets. Or an American waterfall, which is where when you sell an asset, what happens is that asset is counted. Once the capital equity that was put into that asset is paid back to investors, then you do the split. The other thing to consider is, do you have to pay back investor capital once you're over the preferred return, or do you share cash flows there and then? There's all of these different considerations. And when you're starting out, the best thing to do is to keep it simple. Favor your investors a little bit because you want to get that capital, you want to get that interest. You can speak with your initial investors, get a feel for why they will or won't invest based on your structure. As you get larger, if you want to raise from family offices, insurance companies, their terms tend to be very, very one-sided towards them, and they control every aspect of your business. On the flip side, if you're dealing with one private investor, what you two agree is completely up to you. You might take 70% of the deal, they take 30%, but they put up all the capital. It's all down to the appetite in the market, your network, your contacts. But the reality is you need to make it attractive for investors, and you need to have solid returns from the underlying assets for it to all work. If you're buying rubbish deals and there's low percentage and you can't keep your promises and you can't give people a good return, then it's not going to work. Start with putting together great deals with great returns, then everyone wins. And that way you can also get a larger share of the profits of the business too. But always, always, always prioritize paying back your investors first. If they get their money back, they get a decent return, they'll come back to you for future deals. This is a long-term game. We're not trying to make a quick buck here. We're trying to focus on the long-term game of raising capital and buying more and more assets, building trust, making sure our investors are well rewarded for trusting us and investing with us, and then over time building up the portfolio too. The other key thing you need to be aware of is something called a PPM, the Private Placement Memorandum. And this is basically the legal document that spells out all of the risks, all of the structure, all of the fees, everything. It has to be 100% clearly marked out in there. And usually a lawyer will put that together. It can cost anywhere from a few $1,000s to tens of thousands of dollars. There's templates you can use to start off more simply too, but it is going to cost you a substantial amount of money to put together. And this is basically like the contract for the deal, for the fund, outlining everything to do with the fund. Who's involved, what shares they get, what risks they take, what they can and cannot do operationally as well. If they can approve certain expenses, everything gets put into the PPM. And it can be, 100 pages plus long legal document. And then the next thing you need to consider is your deck and your marketing materials. So when you're presenting to investors, they're going to want to know a little bit about the deal. And what we'll do is we'll cover an example deck in one of the videos of this course, so you can see how one of those look. But basically what the deck is it's basically a shortened down version of the PPM, of the terms of the deal, plus some pictures of the location, the properties you plan to buy, example case study, maybe your track record, the team that's involved. It's an overview of, basically it's like a business plan for what you plan to do with their money. So you're asking for $10 million. They're going to get approximately 20% returns every year. You're buying these type of assets. These are the returns, these are the locations you want to buy, and this is the team behind putting the deal together, and this is our track record. It's basically a business plan that you're then presenting to potential financial partners as well. So next, how do you find investors? Well, first of all, you need some skin in the game, so you're going to be using your own capital. the very first people you can go to are people already in your network. Maybe you have a rich uncle. Maybe you have some friends that you used to go to university or college or high school with that have, good professional careers, and they're now accredited investors. They make over a certain amount per year. So it's 200,000 individually, 300,000 as a couple, and they have the funds to invest. Another great way to find investors is through networking groups. So for example, you can go to real estate conferences in groups, or you can go to general business networking groups. Some groups have hurdles to get in. For example, you need to have a minimum 1 million net assets, 10 million net assets, or 50,000 net assets, whatever it is to get into that group. It qualifies people. So there may be people who run all kinds of business in there, car washes. They may have a marketing business, an ad business. You're all different business people trying to help each other grow, but it's also a great time to find potential investors for your own business, because a lot of people who are running businesses have surplus capital, are looking for real estate to deploy that capital in. You need to be very aware of the regulations. So there's different types of funds. Some allow you to go after only accredited investors. Others allow you to go after almost, much smaller investors too. And that's to do with the SEC laws, and you need to be very, very careful, which is why a lawyer needs to guide you through this process, and you need to clearly understand who you can and cannot target with your fund. Initially, you're going to be targeting accredited investors only, which means people who have that 1 million plus net worth, 200,000 per year, last 3 years, or 300,000 as a couple over the last 3 years income, and check that you are following all of the rules, because if you break the SEC rules and you bring, you're marketing to investors, or you bring on investors who are not accredited or do not follow the rules, you can be in a lot of trouble, including jail time. So it's very important that you only target investors who meet the criteria of the fund that you've set up, and how that then impacts your online efforts for marketing as well. You can partner with someone who can raise capital for you. So it could be someone who has money already, and they're going to put in cash, or you can partner with someone who has a network of investors, or even funds of funds, or fundraising platforms, crowdfunding platforms as well as another option for raising funds. And then email lists. So again, you need to be very careful you're not breaking the rules, but maybe someone who has a list of a few hundred people, wealthy friends on there, and you want to put it out to them, for example, through an email list as well. So there's many different ways that you can raise funds for your project. Initially, of course, you're going to be starting in your network, but then really people need trust. And so with the first investors, you have to treat them very well. You have to make sure you're providing timely reports. You have to deliver on your promises. And these people will tell their friends through word of mouth. You'll grow that way, and that's the best way to grow. You're not going to get an investor from a quick, Google advert and, get $500,000 investment in. It's very unlikely. There's a trust building process that happens first before someone's willing to place $50, $100, $200, $300,000 with you as investor. So build that trust, deliver on your promises, keep your word. If things go wrong, explain exactly what's happened, how you're going to resolve it, how you're going to fix it. Don't run from it. Always put your investors first in the deal too. Make sure that you deliver what you've basically promised. And so then, what do investors want to know? The main thing is, firstly, is like, what's the potential? What can I get out of it? What's my return going to be? How much IRR am I going to get? What's my equity multiple? So if I put in 100 grand, how much money am I going to get back? So a 2x equity multiple would be 200 grand back. What's the cash on cash likely to be? Is it going to be, 8%, 10, 12%? When am I going to get distributions? When am I going to get my money back? What are the tax benefits? How can I write off some of this, income that I'm going to be getting from the asset using passive losses, for example? How long is the time frame of the whole investment? Is it a 5-year hold? Is it a 10-year hold? Is it a 7-year hold? What is actually going to be bought? What's the use of funds? What asset classes are we going after? These are all important considerations. Then, of course, who's the team behind it? Who are the people behind it? Who's the sponsor? What experience do they have? What track record do they have? of delivering on what they're saying they're doing. If I gave you a business plan for building nuclear facilities and I've never built one before, and I'm saying you can make 50% returns, you'll be an idiot to trust me because I have no track record of doing it, even though the returns are good. But if I promised you 20% returns on self-storage, and the last 5 years I've delivered 20% returns, and I can show that through all the transactions that I've done, then you're much more likely to gain someone's trust. So you need to keep your pitch, your fund raising within the limits of what you can realistically deliver. And if you're not quite there yet, then start small with friends and family money, grow to the point where you can actually show credible track record of what you're trying to do. Final aspect there is you need details on the deal, like the property specifics and the fund structure, the business plan, exactly what you're going to do to deliver value, and then also a financial model of how that all looks and all the costs factored in, all the expenses, all the fees, etc. The other main thing people want to know is, what fees are you going to be charging? Usually there's an asset under management fee. What this is let's say you raise $10 million. You might charge 1 to 2% of the 10 million that you've raised every year of the remaining capital that you haven't paid back to investors as a fee for managing that capital. You may charge an acquisition fee, which is a fee for buying an asset. You may charge a disposition fee, which is a fee when you sell the asset. And these are usually typically between 1 and 2% as well. If you're doing the property management, you may charge a property management fee that's reasonable at arm's length for the asset. And for storage, that might be anywhere between 5 to 10% of the property revenue you would charge on the property, and then you manage the asset and pay that to your management company as well. So these are all different considerations that investors have. And really, in addition to checking all of these boxes, on an interpersonal level, you have to build that trust. They have to believe in you as a person and your team and being able to deliver the value that you promise.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.